Hey all, welcome to the next episode of Reconciliation Loan Syndication part. So today we'll discuss about the break funding fee. So it is a new type of fee as well as we get a break on this part as well because of the it is due to the rate, the standard rate we are using to calculate our interest pay down, drawdown. So it is LIBOR and the LIBOR, and now it is replaced with the some other also. So we'll discuss in this all session how it get replaced and how we can use this. Okay, so we go with the first meaning and definition is need to calculate only when the difference in LIBOR base rate linked to the contract and LIBOR rate existing at the time of a transfer. So it is simply we can say that when the contract has been signed, so what is the rate, base rate is there for. So base rate may be, for example, I will give example of a FX like USD euro. So it is, for example, is 0.50 at the time of a contract, and when it get transferred, the ownership get transferred to buyer, to seller, or something is done, so it goes to 0.55. The difference of that rate multiplied by the contract size is come with a huge amount. So it is also get adjusted in the books of account, into application, at a client side, at the broker side, or custodian side. So how it get adjusted, we'll discuss in this session. So the break fund fee is calculated in difference in this rate. So if somebody asks you, so it directly link with the rate. The fee is settled between the counterparty and the bank, taking into account to increase and decrease in the LIBOR rate, buy and sell attribute of a trade. So it is the counterparty and bank will be taken the account. So steps of this is the break fund fee component is linked with the SLT product. So SLT product is a general description, general idea of a trade like product code, product module, product type, description, product slogan, product security ID, trade date, settle date, anything. The main interest component of each drawdown associated with the QSIP is taken into consideration while calculating the break fund. So what should be considered? The QSIP and the each drawdown amount. The break funding fee for interest components calculated as per below. So here we have given the formula as well. So fund rate amount multiplied by LIBOR rate. So this is a simple formula, but in the further down we have explained the formula as well. The sum of this amount of all the drawdown is taken into the break fund fee and is get displayed to the funding memo screen. So whatever the break amount fee is there is directly included in the one application, which is funding memo screen. So where we can compare with our calculation as well what broker and the custodian and the counterparty is reflecting while the drawdown trade has been happen. So component of this break funding fee is administration cost. Any cost incurred by the lender for early termination, the remaining interest payment, loan amount, and administration cost. So this is a general component that came in play into the part of break funding fee. So again we have discussed this part, the break funding fee. Oh, this is long, but I will short it down. Just a minute. Again, how to. Yeah. Okay, no worries, we'll discuss by here also. Okay, so break funding fee is also known as the breakage cost. So somebody, if you get a term like a breakage cost, do not confuse on this part. It is just a break funding fee. Compensate lender when borrower repay a loan before the end of an interest period. So what is the rule of lender and borrower? We have mentioned here. Causing the lender to incur the losses for the unwinding and funding agreement, but both in LST and loan syndication association. So it is a what causing them while settling this is the rate. So we have mentioned here rate. So same for the LMA market as well. If you go here, so same for the LMA market. It protect for the such fee to lender for losses during the early prepayment. So when the rate is different, so it will become the huge difference. So we'll take the example here for LSTA market first. So LSTA market 10 lakh dollar loan amount, 0.4 is the interest, replacement interest rate is 0.025, remaining period is 0.16, calculated according to the 60 days. So it is this. So same formula we have used, the 10 lakh dollar multiplied by 0.04 is original interest rate. Now interest rate changed by the 0.025, we have mentioned here, multiply by number of days, it happen into multiply by 0.04 the replacement rate plus 1, and then it get calculated is 24,000. The same formula we have used for the LSTA market, means Europe market, and then we came to know about what is the amount that we have to bear. So here I came with a summary as well, LSTA market and LMA market also. You can note this formula while you will give the interview or when you calculate in your organization. This will really helpful. Just you have to change the number of days the contract get in the existent, and then the rate replacement, the all the thing is mentioned by the contract note as well, the drawdown contract note. Accordingly you can calculate it, but the formula remain the same. So here the new term, this first there is a LIBOR, BBOR, and now the new rate verification is SOFR, secured overnight financing rate. So now it is replacing LIBOR as well. So shortly we will get a new loan syndication notices or trade with the SOFR also. So if you need the full detail about this, you can just comment us. We will prepare the video shortly on this part also. So we came with the end. Now the summary. The break funding fee is designed to compensate lender for losses. So it is who save here? The lender from the losses. The lender is saving here. They incur when borrower repay the loan early and forcing lender to reinvest at a lower rate. Means here the borrower take a advantage, he pay early and reinvest into lower rate. So they have to compensate the lender, because lender, if they have 1 year agreement and the borrower will pay in 6 months only, so the rate they lost the interest rate, the lender get an interest rate from the borrower, but they loss of the 6-month interest. So that's why borrower has to compensate him with this break funding fee. The fee depend on the interest rate differential, remaining period, and the loan agreement. So interest rate differential as well, the remaining period they have to consider, and the loan agreement. Understanding this course is critical for borrower who consider early payment as a significant impact on the cost of the loan as well. So this is a part. So this summary is important when you want to explain this product to somebody else, so this summary play the important. We have designed the summary as well. So hope you like this, all the content of a break funding fee or breakout fee, because his second name is breakage cost as well. So do not confuse on this part, it's same only. So hope you like this, all the content. Please do not forget to subscribe, like this channel. We came with the next video shortly on other fee as well. Thank you so much for watching.